Welcome everybody to the winter 2021 QEC press briefing. Big document, lots to get through today. Before we start, I'd just like to welcome two new team members we have to the QEC team, Eva Shield and Owen Kenny, who are joining us. Their first QEC, recently joined the Institute. And also like to give my best wishes to Carl Coffey, who's finishing up. This is his last QEC. So I would just like to say thanks to him for all his inputs over the years. So let me just share my screen. Bear with me 1 second. And okay, so obviously there's a very uncertain environment at present. So it feels like a little bit like Groundhog Day. We're heading into Christmas with a new variant and a deteriorating public health environment. But despite these ongoing risks and the change in the epidemiological situation, the Irish economy has performed remarkably this year. We entered 2021 with a very strict public health lockdown. We gradually unwound as the vaccine program came through, and the economy and society returned to some degree of normality. And in line with that, the economy really did begin to recover through the second and third quarters of this year. I think it's very clear from this work and from previous commentaries, the exceptional performance of the Irish economy is really stands out both in an international context and just in terms of the trend over time. We're looking at a headline forecast for this year for 2021 of 13.6%, which is really unprecedented, and mainly due to the activities of the multinational sector, and in particular very, very strong export activity, and we'll talk through the detail of that as well. The more adjusted modified domestic demand figure, which we now forecast in line with a number of other commentators, is a much better guide for what's happening here in Ireland. Modified domestic demand picks up household consumption, picks up in government expenditure, and it picks up core investment, modified investment. So that excludes the intellectual property investment and the investment in aircraft leasing. So it gives a much better guide for what happens in the domestic economy. This indicator is still expected to grow at a very, very healthy 6.2% in 2021, and we expect that to pick up into the new year at 7% growth for next year. So very, very robust recovery in the domestic economy. And I think the two areas where you can see that very clearly, and we'll talk them through in detail, are in the labour market, where there's been a rapid decline in unemployment and a very sharp rebound in household spending, in particular as retail outlets, etc., were opened to the summer period. It's a very rapid rebound in expenditure by households on goods and services. So they're two of the key sources of the domestic growth. Naturally, the very rapid improvement in the domestic economy has passed through into improved public finances, and we've had quite a rebound in tax receipts, much higher than we had expected. Now, that there's obviously increases in corporation taxes as well, but certainly there's been a considerable easement on the pressure on the public finances, both through the reduction in the share of unemployment benefit recipients, but also through the other general buoyancy, which has led to higher tax receipts and eased this pressure on the public finances. As I said, for the outlook for next year is caveated amongst, in the context of the ongoing epidemiological situation. There is a lot of uncertainty on the environment or on the outlook. This isn't just to do with COVID. There are other risks related to higher than anticipated price increases, and also the ongoing the trade disputes between the EU and the UK, which kind of cloud the accuracy of the assessment of the forecast horizon for next year. If any of these risks deteriorate rapidly, particularly the COVID situation, and we see a return to more stringent public health measures, then obviously that will lead into the growth outlook for next year. One of the things that you'll have seen for the commentary for many years is that we provide a base estimate. So we've always had one forecast per annum that's been provided. However, given that there are a huge number of risks that you can foresee on both the upside and the downside, you'll see an extra feature of this particular commentary is we've added in a risk register, which has allowed us to kind of walk through the main key risks, both to the upside and the downside that we see at present, and allows us to kind of give some directionality on how those risks would play through to the main components of the outlook. So you'll see that in the commentary as a new feature for this particular iteration. And we feel it's a good complement to the single base forecast that we provide per annum to just spell out these risks and the directionality of those risks specifically. So you'll see that in the commentary. One of the other features you'll also see in the commentaries, we've added a nowcasting estimate for modified domestic demand for the current quarter that's been provided by our colleague Paul Egan, who's developed a nowcasting model, which we will include as a complement to the overall forecasts for the current quarter. You'll see that in the commentary as well. So let me talk a little bit about consumption. Obviously, household spending is a very large component of our macroeconomy. It drives domestic activity to a very large extent. The profile of the recovery in expenditure was very clearly linked this year to the public health restrictions. So we had a dip in consumption in the first quarter, very strong rebound in the second quarter, and then we still had an increased rate of consumption, but not as the increase wasn't as rapid as in the second quarter. And what you can kind of see through the profile of that trajectory is that households appear to be managing their spending over time, in particular with public health measures coming in and out, and with that in general, there has been quite a rebound this year. We still are below where we would have been had the pandemic not occurred. If you take a trend line and just grow that forward from the end of 2019, consumption outturn is still lower than that trend, so we haven't fully recovered, but the recovery is taking a pace and is continuing to grow rapidly. One of the interesting features you'll see in the document is that we have compared the share of spending across different types of items using credit card expenditure data. And actually, at present, or up to the latest data, if you can compare back to 2019, the share of spending across different items has gone back to where it was across most groups of expenditure, which kind of indicates households are normalizing their expenditure patterns across the different groups of goods and services that we'd expect them to be consuming, and that's very different from the 2020 picture. Remember the end quarter of 2020 had a level 5 lockdown in it last year, so there were restrictions on expenditure. I think one of the other features of the consumption recovery in Ireland has been the dramatic increase in the savings ratio. So you can see that the figure here compares Ireland with other European countries in terms of the savings ratio. So that's the proportion of disposable income that households put away in savings, and you see it dramatically increased in Ireland throughout the pandemic period. And even now that we have had a period of reopening and a period of a rebound in consumption, you can see that the latest data that we have indicates the savings ratio is still well above the pre-pandemic norms. So if households have been adding savings to their financial assets and the savings ratio is still above what it was before, this really shows that there's a lot of savings in the economy that can be used to purchase goods and services or to invest. And even a reduction in the savings ratio here to pre-pandemic norms without even unwinding the built-up savings balances should provide an increase to consumption expenditure. And that's one of the reasons why we still have a reasonably robust forecast for next year, 7.8% growth rate for next year. In terms of the investment outlook, the headline investment figures are obviously clouded by multinational activity, in particular big drops in investment towards the early part of this year with multinational activity. But the modified investment, which is, as I said, strips out the aircraft leasing and the intellectual property activity, is forecast to grow at a much more modest pace this year. So we're talking about 4.2% growth this year, but we do expect that to kick back in next year, as hopefully some of the uncertainties wane towards the latter half of next year. Obviously, with investment, it is a flow. It is the degree of uncertainty in the economy always has a disproportionate effect on investment as firms build uncertainty into their outlook, and you know, when they may have to make big capital purchases, the degree of uncertainty really matters for whether they go ahead with that. So we don't see the robust recovery in investment as we have seen in consumption for this year, but it is still a strong recovery. As with consumption, if you take the modified investment series, we still are below where we were if we had not had the pandemic. So if we carry a trend forward, so there is below trend investment relative to the pre-pandemic period, and any deterioration in the epidemiological situation, which increases the broad degree of uncertainty, is likely to weigh on investment into next year. So that's certainly an unknown that we have going forward. In terms of trade, the trade figures are really what's driving the exceptional growth in the Irish economy this year. The very rapid double-digit growth that we're seeing is hugely driven by a massive expansion in exports. You can see we're forecasting export growth of 16% this year, and that's on the back of a major expansion of exports last year, so 9.5% last year. And again, we're looking at quite a healthy growth rate for exports for next year. In terms of imports, we saw a drop last year. We are forecasting a drop for this year. So if you think you've both falling imports and growing exports, the balance of trade is widening, so that the impact on GDP is widening from both sides there. And that's leading through to the very robust figures that we're seeing on the export side. But while we have seen the multinational related activity and the internationalization activity really drive forward the exports, in particular the very high figures, we are seeing a more broad-based recovery in some of the other sectors, and we can see it in services, goods. These are rebounding not only in the multinational sector, so that is as a comfort. And the degree to which some of the domestic exporters will be affected, a rising tide internationally, so recovery internationally will lead through into higher growth for these companies, and that's certainly a good thing. Naturally, clouding the Irish trade environment, notwithstanding the broader global factors, is the ongoing trade activity and discussions, should say, between the UK and the EU around the cooperation agreement. Obviously, at the present, the rules are being applied asymmetrically, and that's leading to some quite asymmetric effects on the trade figures, and in particular, the imbalance of customs checks between goods from Great Britain to the EU is certainly leading to some differential effects relative to what we would have expected, and we do see that unwinding going forward. And again, as we've said on multiple occasions, and much of the research the SRI has done around this shows that the uncertainty around the UK EU trade does have a significant impact on our trade relationship going forward. So moving to the labour market, this is really where we've seen the quite dramatic improvement in the domestic economy. The unemployment rate has dipped in the most recent data to below 7%. So we're looking to exit 2021 with a rate that's going to be below, very much below where we had expected early in the year. The full year for 2021, we're still forecasting 16.1%, but that's because the unemployment rates are so elevated earlier in the year, but they have dropped back quite dramatically towards the the end of this year. And we see that carrying forward into next year, and we're forecasting an unemployment rate of 5.8% for the full year next year. Obviously, in the labour market, there have been huge policy interventions to backstop the labour market with the COVID shock, and in particular the wage subsidy and the BUP have helped to uphold household incomes. And it's not, but as we've seen the economy recover, the number of recipients, particularly of the BUP, has dropped off dramatically. From a peak of over 500,000 in May 2020, this is 54,000 in the latest data. So you can see the dramatic improvement in the labour market through that lens. The chart here on the right-hand side shows BUP recipients by sector of the data from the latest data in 2021 to December 2021. So you can see that the sectors that are still contributing the most to the BUP are some of the sectors that have been hard hit, in particular retail, accommodation and food services. So there still is a concentration of impact in those sectors. And naturally, if we move forward into a period of higher public health restrictions, or if there needs to be a return to public health restrictions, it would be expected that labour market deteriorations would be concentrated in these sectors going forward. Again, to just highlight the fact that these improvements in the labour market, while they are welcome, they are uneven, and there are risks to them. In particular, that there was risk that in some of these sectors where the unemployment remains elevated, there's quite a vulnerability to long-term unemployment for those persons who are currently unemployed in those sectors. So this chart gives a really nice visual on the dramatic decline in the unemployment rate for this year. You can see the COVID adjusted rate here, the upper bound of the COVID adjusted rate in red. And from starting at 27.1% in January of this year, you can see it's dropped dramatically through the year, and expect that to continue to come down, but at a much more modest pace as we go through 2021 or 2022. So at that point, I'm going to hand over to Kieran to talk about the public finances. So I'm going to stop my screen share, and Kieran's going to take over. Many thanks for your time.
Thanks, Conor. So as Conor said, thanks very much, Conor. So as Conor said, obviously the significant improvement in the economy through the present year has obviously been reflected in terms of the tax take. And we've seen very, very significant increases in nearly all of the major tax headings, income tax, VAT, excise duties. You can see there for the year to date from January to November, you can see overall receipts are up 20%, and you can see within that, income tax up very strongly, VAT up very strongly, excise and corporation tax once again, I suppose, really increasing to quite a large extent, and certainly to a far greater extent than what most people would have forecasted. So a significant increase in government revenues above and beyond what would have been expected certainly at the start of the year. Situation then has been further improved in terms of the public finances, because there has been, to date, there's been less expenditure than would have been budgeted or would have been forecast. So if we look at between January and November, we're running around 2.5 billion less than target as far as expenditure is concerned. And there's obviously a number of reasons for that. Clearly, I think the expectation at the start of the year was that the COVID situation would probably necessitate a higher level of expenditure than has turned out to be the case. But it may also be that there's been less expenditure in other areas due to some of the restrictions as well. So in areas like construction, where you do see less expenditure than has been targeted. Now, again, this is just for the year to date. Obviously, the final figures will tell their own picture. But clearly the better than expected outcome for the public finances can be seen then in terms of the headline indicator. So if we look, for instance, at the general government balance as a percentage of GDP, This year, we expect it to be at 2.3%. Next year, we expect it to be down to 1%. So, I mean, clearly, you're seeing that the public finances are back on a sustainable footing from, obviously last year you had a government balance of around just under 5%. So clearly the economy and the public finances are returning to a more sustainable footing. And that's mainly due to the very strong growth in the economy. And you can see then in terms of both debt to GDP and debt to GNI star, you can see that it's falling quite sharply between 2021 and 2022. And obviously this allays some of the fears, I'm sure, about the public finances in terms of the impact of the pandemic on the public finances. You can see that the economy has done the heavy lifting in restoring order in that sense. In a box of the commentary by my colleague Wendy Dish and I, we look at the implications of this in terms of the likely size of the government going forward. So there were opinions expressed about what the implications of the pandemic and the expenditure on the pandemic would mean, as well as other budgetary issues, would mean in terms of the likely size of the state going forward. So in the box, we chart out some of these factors and we kind of examine them. And then taking the latest government forecasts on the expenditure side, we examine what we think is likely to happen as far as the size of the state is concerned going forward. And what we see is that whilst obviously you had this peak in terms of the size of the state in 2020 and 2021, because of the elevated levels of public expenditure, we think that as you move out into the future, total government expenditure as a percentage of GNI star is set to remain relatively stable in the years ahead. So from 2023 onwards, 2022, 23, 24, you can see that it's very much down at a much more level basis, if you like, somewhere where it was analogous to where it was in the kind of 2015, 2016 period of time. So I think it's fair to say, again, this is predicated on the expenditures are the official expenditures as outlined in the budget. So these, of course, may be revised upwards in the years to come. But certainly at present, if we take those forecasts as given for the coming years, in terms of the likely trajectory of the economy, it seems that expenditure as a percentage of GNI star is not set to increase dramatically in the years ahead, and in fact is set to remain relatively stable. So again, that's something which I suppose there were opinions expressed as to what was likely to happen in terms of the size of the state, but certainly we think that's likely to be relatively stable over the medium term. Inflation obviously is a very significant, has grown significantly over the last few months in terms of its relevance to the economy, particularly with the elevated rates that we have seen. And in particular, if we look at November, we see that the rate had increased to 5.3%, which is the highest rate for a good many number of years. There's a number of reasons, of course, behind the current surge in inflation. There is the base effects from last year, the fact that you can see from the chart that you had a deflationary period in 2020 during the public health measures, which almost necessitates that when you have any kind of an increase in 2021, it's going to show up as a relatively large increase in inflation. Obviously, with the opening up of the economy itself, you have a surge in demand, and clearly the supply side of the economy, both domestically here and of course internationally, has been constrained due to various different international supply chains issues. And so those have all contributed to the surge in inflation. The other issue, of course, is the situation in energy markets. And we have a box in the commentary by our colleagues who work in this area. So I think Niall is on the call here, and his colleague Maureen Lynch. And they have a very interesting box which looks at the pressures in the energy market at present. What are the reasons behind the surge in energy prices? They discuss those, go through them and talk about them. So I think that's a very interesting addition, if you like, to the commentary this time out. In terms of our outlook for inflation then, so this is basically how we see it emerging and evolving over the coming year. We expect that inflation will continue to rise until the early part of next year. So particularly up until March, we expect to see quite a sizable increase in inflation up to that point. But thereafter, we expect that the rate of inflation will decline. And by the end of 2022, we expect to see the inflation rate back down to around 2% at the end of the year. And that will occur, we think, because a lot of the supply chain issues will have worked their way out. We think there will be easing of some pressures as far as the energy markets is concerned. And of course, the base effects will work in reverse next year. The fact that we have very high rates of inflation at present means that more than likely this time next year, you will have relatively low rates of inflation because of the base effect working in the opposite direction. So that gives you an idea of our trajectory, or expected trajectory for inflation over the next year. So overall 4% for 2022 in annual terms, but by the end of 2022, we expect that it'll be coming back down towards the 2% rate. The other addition that we've had in the commentary is a box on climate change in general. And again, this is from our colleagues Kelly De Bruin and Mert Yakut, who work extensively in this area. We have added it as a kind of an ongoing addition to the commentary, given the huge importance attached to climate change and in terms of its implications for the economy right now, as opposed to something which people traditionally thought of as something over the longer term. And that box basically talks about the recent climate action plan and some of, in terms of its importance and in terms of outlining the kind of emissions targets that are there and how we are likely to get to them. And in particular, it looks at the whole issue of carbon taxes and the role that carbon taxes can play, and the importance of tailoring carbon taxes in a manner, and policies around carbon taxes, tailoring them in a redistributive manner to limit the impacts on the real economy, and in particular to alleviate income inequality because of the adoption of carbon taxes. These are hugely important in terms of changing behavioral attitudes around the whole carbon issue. But you need clearly designed policies to ensure that the weaker elements of society are not hit disproportionately by the adoption of these measures, particularly as they are set to continue to be a key part of our policy response to the climate issue over the coming years. The other addition to the commentary, which Conor talked about there at the start, is the risks. So we have an explicit section on risks to the outlook, if you like, in terms of our baseline forecast. And clearly, at the present point in time, there are a number of uncertainties. Clearly, COVID and even the emergence of Omicron in the last few weeks has highlighted and stressed the fact that we are still not over the pandemic and that it still has the potential to have a very significant impact on everyday life and consequently on everyday economic life. And what we do is tease through the implications of some of the downsides, mainly as far as these risks are concerned, in terms of what they would result in for the key economic variables. But we also talk some of the upsides, and those can occur as well. There's always upside risks to the forecasts, as we've seen, particularly, for instance, in areas such as corporation tax, where we've seen much higher returns than we would have expected. We talk about the risks that come from high inflation, the implications that may evolve if you have higher rates of inflation going forward. And also we talk through some of the Brexit-related disruptions which could occur if we see, for instance, a deterioration in the trade relationship between the UK and the EU, if we've ongoing uncertainty concerning the issues around the protocol, the implications of those for mainly the key trading variables, but also obviously they would have a knock-on effect then on some of the key kind of domestic economy factors as well. So therefore, overall then, in terms of our assessment, we see a very strong performance, double-digit headline growth performance for the Irish economy in terms of GDP. As we are well aware of at this stage, GDP, movements in GDP don't really accurately reflect the underlying growth dynamic in the economy. So when we look at a measure like modified domestic demand, we also see a very strong performance, but obviously it's not growing as sharply as the GDP measure. We see particularly strong evidence of recovery in the labour market, where we've seen a very significant fall in the unemployment rate. And I think this is, again, outstripped our expectations, certainly in terms of the fall in the unemployment rate and the growth in employment. And the key element, I suppose, of the growth performance to date has been, both the strong export sector over the last couple of years, but also this year we've seen a resurgence in domestic sources of growth in investment and consumption as the economy has opened up due to the relaxation of the public health measures. In terms of other issues that we talk about, clearly the fiscal rules, which have been very important in terms of governing fiscal policy over the last 10 years or so in the EU. Quite a lot of speculation about how these may be reformed when they are re-adopted, if you like, having been suspended during the pandemic. And we talk about some of the ways in which these measures can be reformed, particularly in light of some of the climate change challenges that are there as far as public expenditure is concerned. And finally, then the issue, as I said, of uncertainty and risk going forward. Clearly, there are a number of risks to the baseline outlook going forward, particularly in terms of inflation, Brexit, and more variants of the of COVID-19, which may result in public health measures being adopted again in 2022. So that's the end of the presentation.